For the longest time, investing in the next big startup, well, that was a game pretty much reserved for venture capitalists and the super wealthy. But you know what? That's all changing. Today, we're gonna dive into how investment crowdfunding has grown up. It's not some little experiment anymore. It's a multi-billion-dollar force that's completely reshaping how innovation gets funded. So let's break down how we got here, and more importantly, where this whole thing is headed. So what is investment crowdfunding really? Honestly, one of its main architects, Woodie Neiss, said it best. Think about Kickstarter, right? You chip in some money to help a cool product get made. Now imagine doing that, but instead of getting a t-shirt or an early version of the product, you get a piece of the actual company, equity, a real stake in its future. It's that simple, and at the same time, it's that revolutionary. Okay, first up, let's talk about the big idea itself. This all kicked off with something called the Jobs Act back in 2012. Now, it took a few years to really get all the rules in place, but by 2016, the floodgates for this new kind of investing were officially open. And this was the real game changer. For the very first time in modern history, innovative companies didn't have to fly out to Silicon Valley and beg a handful of gatekeepers for money. Nope, they could go straight to their own customers, their biggest fans, their communities, the general public, and raise the money they needed to grow. It was a total democratization of finance. So the big question is, did this idea actually work? Well, let's look at the numbers, because the data here tells an absolutely incredible story of how this industry didn't just grow, it totally exploded. Let's just start with the headline number, shall we? To date, more than $2.3 billion have been invested into startups and small businesses through this kind of crowdfunding. And that's just in the US. I mean, let's be clear, this isn't pocket change. This is serious growth capital that's launched thousands upon thousands of companies. And who's putting up all this cash? It's not a handful of billionaires in a boardroom. It's a crowd of over 2 million individual investors. These are regular people writing checks, sometimes big, sometimes small, to fund the companies they truly believe in. It's the perfect picture of the crowd in crowdfunding, a huge, powerful network of financial support. And that investment, it has a massive real-world impact. We're talking about the creation of over 310,000 jobs. These aren't just numbers on a spreadsheet, you guys. These are real people, real families, pumping something like $6.8 billion back into their local economies every single year. Now, what's really fascinating is how the kind of company raising money has changed over time. Back in 2016, this space was full of, pre-revenue ideas and brand new startups. Fast forward to today, the average company raising money now is 4 years old. And get this, 65% of them are already making money. We're talking over $1 million on average. The whole risk profile of the industry has shifted big time. And this right here might be the most surprising stat of them all. So the Bureau of Labor and Statistics says about half, 50% of all new businesses fail within 5 years. That's pretty standard. But for companies that successfully raise money through investment crowdfunding, that number plummets to just 17.8%. So why is that? Well, one theory is that these companies build a loyal army of customers and fans before they even launch. That built-in support seems to make them way more resilient from day one. But all of this success creates a brand new challenge. And that brings us to our next section, the AI revolution. We're about to see how technology is serving up a very modern solution to a very old investment problem. It really is the classic problem of too much choice, right? With literally thousands of companies out there raising money, how can any single investor possibly do enough homework to find the hidden gems? And for the industry as a whole, how do you attract the big institutional money when it just looks like a chaotic sea of startups? Well, the answer is AI. You've got firms like D3VC now that are feeding these massive data sets, we're talking 125 data points on every single company, into machine learning algorithms. The algorithms are basically trained to spot the patterns, the little signals that successful companies have shown in the past. It's only after the AI flags a company as promising that the human team jumps in to do that final layer of real-world analysis. And here's the ultimate goal of all this. Using AI isn't just about helping you or me find a good investment. It's about creating data-driven proof. It's about being able to walk into a big Wall Street firm and say, hey, look, our algorithm can reliably identify future winners. That is the key to unlocking the next level of big-time capital for this entire industry. Now look, it's not all a perfectly smooth ride. And that brings us to our next section, obstacles and opportunities. the industry is definitely still growing up, and it's facing some real hurdles. But getting past them could unlock even more incredible potential. On the obstacles side, you've got things like the really high cost of financial reviews, which can be super tough for small companies just starting out. And then there's the political gridlock in Washington over some pretty simple bills that could raise investment caps, which is kind of holding the industry back from what it could be. But, and this is a huge but, look at the flip side. In 2023, nearly 42% of all the successful crowdfunding campaigns had at least one woman or minority founder. Now compare that to traditional venture capital, where that number is way down, hovering around just 2%. I mean, that's not a small difference. It's a monumental one. It shows that crowdfunding is actively funding a much more diverse and representative group of entrepreneurs. It's amazing. Which brings us to our final section, your seat at the table. Why does any of this matter to you? Well, because this whole evolution from a kind of niche idea to a sophisticated data-driven industry means the opportunity isn't just theoretical anymore. It's real and it's tangible. The simple truth is this: access to this asset class, early stage, high growth companies, it has fundamentally changed. The table has gotten much, much bigger, and now there's a seat for pretty much everyone. In fact, you can even use retirement funds to get involved. Something called a self-directed IRA, or SDIRA, is a special kind of retirement account that lets you invest in alternative assets, stuff beyond just the usual stocks and bonds. This can include real estate, precious metals, and yup, you guessed it, equity in the very startups we've been talking about this whole time. So let's recap. We've gone from a simple concept to a multi-billion-dollar market that's creating hundreds of thousands of jobs and funding a way more diverse generation of founders. The crowd has absolutely proven it's a major force in innovation. So really, the only question left is, where is all that capital, all that intelligence, and all that passion going to invest next?